Welcome to the Power Forward Pod, hosted by the Power Forward Group Financial Advisory Team, where we believe 2 is better than 1, dialogues are better than monologues, thoughts are meant to be challenged, soundboxes are always the enemy, and change is the only constant. I'm Ruvin Levavi, and I'm joined today by Joe Shalom, who's dressed for work today.
How you doing?
Great. And Bobby Kaslander, who's dressed like it's fall.
What's up, guys? Yeah, love vest season. Fall's the best. You got football, pumpkin spice lattes. What else can you ask for?
Right.
Warmer weather, maybe?
Oh, yeah. I mean, that's why Joe loves the credit card points, right? Always looking to get out of town. But today we're gonna cover a topic that I think a lot of us like to think about, and a lot of us don't like to think about. It's a pretty dynamic issue. So, Bobby, what are we talking about today?
Yeah, a couple things. I think a key theme right now, right? Just because with the election less than a month away, we're going to talk a little bit about election cycles. Does it make a difference in markets on who wins the White House? Different policies between both candidates right now, and I think we got some pretty remarkable stats to go through today that I think our listeners are going to find valuable.
And Joe, we get asked the question for the last since August. I think we've been hearing the question all the time, right? What question we've been hearing from clients?
Yeah, should I wait to invest until after the election?
Right, it's the most common theme. I think people are always looking for reasons to say, "Hey, should I wait to invest?" But I'll skip the ending. The quick takeaway is obviously not. I mean, keep pumping money into the market, keep growing. The market's been doing great, but we'll tell you a little bit about what we think about. And Bobby's brought some great stats today to back it up. And Joe's going to get into a deep policy discussion on the ways the two candidates can and will potentially affect our own financial situation. So I think we're going to think about that high level today, is breaking down one side as the markets and then the other side ourselves individually. So all we've been seeing in the newspapers is why one candidate or the other is going to win the election. It seems to be like it's pretty close. One candidate is brand new, and the other candidate is coming around for a second time, which also kind of will lend to the prism of their policies and what we're thinking about. But back to that, the headline grabbing question. Bobby, right, from your perspective and from kind of what the data shows us, do presidential elections affect markets?
What do you guys think? Yes? No?
I would think yes. I do. I do think it matters, actually.
Do you?
If you asked me to guess, I would think, if there was a Republican in the White House, I would think the markets actually would do better because their policies generally revolve around cutting taxes, increasing businesses, and the market's all based about business. So I think businesses would do better for Republicans in the White House.
Right. So I think every piece of noise that's thrown at us, at public in general, Joe Public will call it, is yes, whatever's happening in the world will affect the market. And I think that's because people think about things first and foremost with their pockets, right? So if you want to get somebody's attention, you say, hey, it's going to affect your pocket. Now you got readership, right? Whether they're interested in politics or not, we'll discuss on Thanksgiving table. But man, you can make somebody pretty interested in politics. You tell them, hey, the market's going to tank or the market's going to go up a lot. That gets my interest. So what does the data show us?
Yeah. So Joe, I definitely have to agree with you. Like before doing a lot, we've done a lot of research on this over the years, right? Every 4 years, I feel like we're getting asked this. This is kind of the time of the year. Clients are always asking us. Reuven, we had a client yesterday ask us, should I wait? Doesn't make sense to wait until after the election. And I think the general takeaway of today's discussion and what we'll go through today is that it does not make a difference who is in office, right? We should not be mixing politics in our investments, and we should just keep politics out of our portfolio and investments. Now, obviously, I'm not saying it doesn't make a difference who becomes president. I think each candidate has different policies that may affect clients or people on an individual basis a little bit different. But to say that one person alone can affect, a $50 trillion market cap, there's 25, 30 trillion in GDP each and every year. To say one person alone and predict who's going to, take over in the White House is going to have a massive effect on the market there's not much correlation to that.
But isn't that what candidates tell us? They say, hey, my job is to steer the American economy. Isn't that what they want to tell us?
I mean, that's their job. That's politics, right? I mean, you take a look at when Barack Obama was kind of running, right? The Republicans were calling him a socialist. They thought he would end capitalism, right? Instead, the stock market took off to one of the most insane bull markets we've seen since in its history. Democrats were also predicting the economy was going to get shut down during Trump, and the market, aside from the small blip during COVID, right? Market ended up having pretty great 4 years there. So I think the general takeaway, and we'll go through some stats here, but long term, the market market's going to go up, market's going to go down. But historically speaking, markets go up over time, no matter who is in office.
Right. Okay, great. So market keeps going in that direction, kind of like SpaceX, right? Keeps just taking off and flying high. When and how does the market get affected by presidential elections?
Yeah. So if you take a look at the data, right, the market generally likes predictability, right? The market does not like surprises. So when you take a look at that and factor in politics, right, when is the best time? When is the market going to have the best returns? Generally speaking, when there's gridlock.
That's interesting.
Right.
Wait, let's define. What's gridlock mean?
So gridlock is when not one party or the other has control over Congress and the White House, right? So if there's a split government, generally speaking, not much is going to get passed just from politics. Take a look at kind of the historical performance there, which markets like. It's when Democrats take control or Republicans take control when there's going to be these massive changes to the economy, to policy that may affect the markets that they can't foresee.
So it's super interesting. Predictability is almost gridlock, right? Because we can't predict what one side or the other is going to do. So if we speak about gridlock, then the markets kind of keep going as they're going. So we've seen net positive effects from gridlock. Is that what we're coming out at?
We have, yeah. And there's some interesting charts that, Joe, I think I sent it to you, and Reuben, I'll make sure to share it with you as well. There's some statistics behind that, when Democrats are in White House, Republicans in White House, and whether or not there's a split Congress or a unified Congress. And there are some remarkable stats showing that when there is gridlock, there is a much higher average rate of return in the market.
Right. So that's one of the things we do know about the upcoming election. Well, we don't know, but we've been hearing a lot, right? It's very close, not just presidentially, but also the two houses of Congress are really close. And our presidents aren't dictators, we think, right? So we believe that public policy has to change through government. So we might very well end up in a situation where maybe to the plus and upside of the market, we end up with split houses. If not, is there anything we can learn from presidential cycles?
Yeah. So these were some of the most remarkable stats I've seen, and I find this so interesting. So presidential cycles, there are a lot of investors out there that invest based on what year the president is in his current term, right? So this is what's called presidential cycles, and there are some remarkable stats that'll actually show different years throughout the president's term, whether it's the first year, second year, third year, fourth year. Markets have performed much differently. Historically speaking, market returns have generally been the worst or most difficult during the first 2 years of a president's term. More specifically, that second year of the president's term generally is the worst year in the market. Taking a look, right, the most recent one back in 2022, I think we all know how the market performed in 2022, right? The market was down almost 20%. The flip side of it, right, you might be wondering what might be the best quarters historically speaking. So generally the three best quarters occur from Q4 of year 2, right, through Q2 of year 3. So it seems like October to June 30th between the president's second and third year term has generally been the sweet spot for markets. Now, there may be a lot of interpretations on why that may be. I think generally speaking, finally getting past the critical midterm elections removes a lot of degree of uncertainty, right? The role of Washington will play in markets, and again, typically gridlock plays a role there as well.
So at that point, there's the potential that the market knows which direction we're heading. It could have some forward-looking predictability.
Exactly. Yeah. I mean, and things tend to get a little volatile, right? With midterm elections, heightened sensitivity with politics, a lot of uncertainty starts to arise in the market. And taking that statistic one step further, right? So post midterm elections, there has never been a negative return from the actual date of that midterm election to June 30th of the following year, that quarter that I mentioned. So that's...
Wow. Oh, never?
Never. So it's been 21 consecutive times. It's going all the way back to like the 1920s or 1930s. 6 of those occurrences have resulted in a net return of 20% or greater. Taking a look at how we did this past cycle, 2022 to 2023, the market was up 18%.
All right, so now I know when to wait to invest to.
Well, I mean, I hope, but I grew up as a Yankee fan, right? And my favorite thing walking out of Yankee Stadium was every year I grew up was all you'd hear, even if they weren't playing the Red Sox, you'd hear 1918 over and over again. And Yankee fans were making it very clear that things were consistent. Yankees always win the World Series, Red Sox don't until until what?
They don't.
Until it changed, right? So don't bet the house.
Maybe this year.
For the Yankees, yeah. But and definitely not for the Red Sox. But don't bet. I mean, I think that's an amazing, really cool stat. But at the same time, like, I wouldn't bet the house on one side. So how do we, when we think about client accounts?
I wonder actually, is one of the reasons why you think it's up so much is because the market was down. Generally speaking, the market tends to do very well after the market drops.
Again, that could be very well. That could play a big part of it as well, right? Markets generally, recover quickly after big downturns, so that could certainly play a role in it as well, Joe.
Yeah. So if we're going to tell clients, though, we're not sure why it's happening, we think we might know, and don't bet the house on it, how do we advise clients, generally speaking, like in terms of just timing the market, cyclical investment timing?
Got to invest every single month. Dollar cost average in, right? Take emotion out of it. That's the idea, right?
Yeah.
Bobby just showed that politics don't have a matter in the market, so let's just stay in the market because we don't know what's going to happen, right? Market's going to go up, it's going to go down. More often than not, the market's up, right? I think the stats over like 75% of the time the market's up. We just want to be in the market.
Exactly, right? And I think that's part of what our job is, right? It's just helping clients manage their emotions and expectations. Yeah. Remove politics out of your portfolio, right? Continue to dollar cost average and try to block out the noise.
Yeah. When should we talk about politics?
Just at Thanksgiving dinner.
No, but I think to that, I think Bobby's point there is, right, when's the market been down during elections? Really when big things happen, right? COVID 4 years ago, right? That was a global event, right? The Great Recession 2008, right? That was a presidential year. The stock market crash in 2001, the tech bubble, right? Then you have like Great Depression back then, World War II. All those were major world events
that people didn't know were coming.
Yeah, that had nothing to do with who was in power. It was just more of world events, and that actually affected the market just from a...
Agreed. Yeah, I think more global macro level issues is what's going to cause the market to move a little bit more, right? Where inflation is, are there geopolitical risks going on in the economy, unemployment? So
returning to Bobby's original kind of question to you and myself, Joe, right? He asked, do we think the market do we think the elections affect the market? And your gut reaction is maybe, I think so, right? Possibly. I think when clients are asking us that, what they're really kind of doing is what people generally do all the time, right? Is it's really hard, right? There's always a hesitation to part with money to some degree, philosophically, right? It's just really hard thing to physically do, to say, hey, I'm going to take money out of my left pocket, my hard-earned money, and put it somewhere where we think it can grow because we run the risk that it can go down, right? That fear of risk. That's very psychological. But I think that point you made before is an amazing point, right? What percentage of time is the market up?
About 75%.
75%. Yep.
Right. And outside of that one quarter that Bobby mentioned before, if you can't predict it, right? Be in it, right? Be in it to win it. Okay, presidential elections, big takeaway, don't generally affect markets. We have some data within different cyclical timings and reasons why we don't think they affect the market and when we think politics in general may or may not have an effect. So it doesn't matter who's elected president from a financial perspective. It doesn't matter, right?
Yeah. Well, it matters from a policy perspective. It doesn't necessarily matter from a market perspective.
Right, because our finances aren't just the stock market, right?
Yeah.
Right. So from a policy perspective, how does policy affect our financial positions?
Yeah. Well, for the most part, it's taxes. I think that's usually the biggest question we get. Does this matter from a tax perspective?
Okay.
And that's, I think, where the two presidential candidates actually differ, right? We're looking at Harris compared to Trump. Their big talking points is really around taxes. I think that's some of the biggest things that we'll discuss now, right? Just either from a simple federal tax perspective, right?
All right.
Trump effectively put the tax cuts in 2017, which is coming to expire in 2025. So everything we've been having over the past 4 years of Biden's presidency was actually enacted by Trump.
Wait, so even though Trump hasn't been president, we've been still feeling the power of the Trump hair?
That's because of the gridlock. Biden couldn't do anything.
From a tax perspective.
From a repealing perspective, right? Trump enacted it, and they couldn't change it.
Okay, why does that code end in 2025? What is that? What's that called?
Sunsetting.
Right. So it ends in 2025 because the law is passed for a number of years. It will end. What happens? What's it set to happen now, irrespective of candidates? Like, what's going to change no matter who wins if nothing changes?
It's going to go back to what it was beforehand.
Which was?
Oh, depends on what we're talking about, right? If you just look at from an estate perspective, the current estate tax is meaning if someone has more than $13 million, first $13 million would be estate tax free. If you're married, it's really $26 million. So that was enacted by Trump. Once that sunsets, it's going to drop down to $3 million per person or $6 million a couple. So a big difference there.
Right. So if we don't know what's going to happen, right?
That's what you got to plan for.
Time to do gifting is right now.
Yeah. Quick question on that is when these tax laws come, when they change this, is it required they put a sunset law in there or a sunset provision in there? Like, how does that work?
nothing's required, but what happens in most negotiations, whether it's taxes, whether it's public policy, whether it's NFL labor negotiations, is at the end of some sort of time period that you put the new policy in place, you want to make it a little bit more complicated. You want to force the next negotiation. So how does that work in sports, right? Have we felt that before in sports, Bobby? The Jets done anything crazy in sports?
Well, today as we're speaking, right, we just traded for Devontae Adams. So,
but the Jets are dealing with what? A salary cap, right?
Jets are dealing with a salary cap, yeah. So I know the salary cap has changed in the NFL for a number of years. But.
Right. Usually when those negotiations, which are labor negotiations, change, what happens is the last year sometimes is uncapped, or the salary cap goes really low. What they're doing is they know teams can't operate and don't want to operate in that sense, so they're forcing that negotiation. Government's kind of similar. A couple of years ago, the estate tax, a while back, sunsetted, and George Steinbrenner chose the right year to die, right? Owner of the Yankees, he died, and there
was no estate tax.
No estate tax that year, right?
Taxes,
Government didn't like that.
Insane. Yeah.
But they couldn't come to an agreement, so we got some gridlock.
That's why the Yankees have one of the highest payrolls in all of baseball, right?
Right. Okay, so let's dive back in. Right, that's why. Apparently now it's a Mets, but let's dive back into real policy, right? So policy changes, right? So we have, on the one hand, we have Trump, who seems to be, from Joe, your point before, a little bit of a continuation of what he was previously, and I think the assumption would be he be different, or do we know?
He says he wants to keep that and add another couple more years onto that. So
okay.
He wants to extend his laws that he did back in 2017.
So in some ways, even though Harris is coming off the incumbency, what would Kamala's new recommendations be? What does she speak?
So she has some things that would actually affect, our clients or anyone actually thinking about this, right? Because it actually matters. Just from a regular federal tax perspective, the current max federal tax is 37%. She wants to increase that up to close to 40%. So as a marginal rate, that's an additional 3%, right? That would affect people's pockets. And when we talk to clients about potentially doing, let's call a retirement account, a traditional versus Roth, it does have a big difference there because that's saving some money now versus later and where taxes are going. So
just to be clear, you're not saying good or bad. You're just saying, hey, there's a different change, and depending where you are, you might want to adjust accordingly.
There's more planning that has to come involved now that this may change, right? We want to think about it from the estate perspective, like you said. You want to think about, does it make sense to gift more this year as opposed to waiting? Because if it sunsets down to $6 million, right? If you own 2 houses, it could potentially be that you're at $6 million plus a retirement account. So there is big differences there. Okay. And then from a business perspective, right now, Trump enacted that the business tax rate would be 21%. Harris is projecting close to 28%. That's what she's looking for. So right there also, 7% more. When people are doing business planning, that matters.
Right.
And one of the biggest things that they're talking about really is just capital gains taxes. I've been seeing this all over TikTok.
Okay, right. Tell us more about capital gains taxes. What
are unrealized capital gains taxes?
Well, let's go back a minute. Yeah. What are capital gains taxes? How do they exist? Taxes are really complicated. Tell us what are cap gains?
You want to do it?
Yeah, capital gain. Well, in terms of stock market investments, right? Capital gains are taxes that you have to pay on gains of any investments, right? You have something called short-term capital gains, which generally speaking is any investment that you've held under a 1-year mark, and anything over that is a long-term capital gain. Long-term capital gains rates are much lower than short-term rates, and they can range anywhere from 0% up to I think 22% might be on the highest end. But it's been a big topic in the news lately because I read something that Harris, I believe, wants to start capitaling unrealized gains. Not sure how true that is, but that would be a whirlwind, and that'd be a massive shakeup.
Yeah, I don't know if that's actually realistic. I think that was more of Biden's proposal. I think she's been walking away from that because realizing that's really, really tough to do, right? Imagine your stock went up, 100%, you didn't sell it, and you got to pay taxes on it, but then it drops the next day, right on January 1st. So you pay taxes on money you don't even actually have.
Right.
And that would cause you to probably have to liquidate other types of assets for that, which...
Yeah, but what she's talking about more than anything else is increasing it from instead of 20% on capital gains tax to 28% if you make more than $1 million.
Okay.
Which, and trying to treat it more like a business.
Right? Well, it's still, that's still less than wages, right?
Correct. But by increasing that, they're trying to add some more revenue in. But at the end of the day, people are holding for long-term capital gains because there is a discount.
Right. And I think there's different philosophies driving both parties' agendas, right? I think that's why we have different policy proposals, right? On the Trump Republican side of things, what guides that philosophy? What are we thinking about, Bobby? Like, what are they trying to solve for by lower taxes?
Well, I think his big belief is he wants to remove government a little bit out of the equation, and he's pro-business. He wants more money to be kept in corporations, in people's pockets, so they can kind of help continue to grow the economy.
Right.
Yeah,
and
his
innovation, I think.
I believe the Republicans' belief is that by giving more money to the businesses, they'll employ more people, wages will increase.
That'll drive growth.
Which will drive growth.
Right. And
which then would mean businesses increase in value, they have more profits, which will then pay more taxes, right? Because at the end of the day, what they're doing is trying to get more taxes, trying to do it the most strategic way possible.
And then on the Democratic side of the equation, Kamala's side of the equation, what are they looking to do?
Increase taxes now because they
to
think
solve
it's
for
be
what?
the same. $37 trillion in debt.
Right. To solve, I mean, we have a massive, right, to some degree, right, we have a massive debt that the government has to deal with at some point. It's our debt in general. So it's debt that has to be dealt with. And also social programs, right? I think there's a big belief in more social programs, and somebody's got to pay those social programs. I think that those are the policy debates that you're going to have at your Thanksgiving table, right? We all have different beliefs about where that's going to go, and that's where the fireworks start. Who's the craziest person at your Thanksgiving table, Bobby?
I don't know. It might be me or one of my uncles.
All right, so you're the one. You're the one who gets into it with your uncle.
We get into it with debates and policy topics, but yeah.
How about you, Joe?
We just watch football all day.
Oh, so you just avoids politics?
Fantasy football all day. That's what it is. We have 4 different TVs going.
What better question is, what is your favorite Thanksgiving dish?
So my wife's uncle actually smokes a brisket, and it has nothing to do with Thanksgiving, but that's my favorite item.
All right, smoked brisket. Yeah. We love politics at our table. It's fun.
I think
it's a great conversation. My aunt and I always get into fights. Sometimes it ends with tears. Not mine. But I think when we think about financial planning and kind of wealth management, what we're thinking about is, hey, not mixing the two, right? Fighting against the urge of all that noise and making sure we continue on. I think the most powerful point is really that first point, Bobby, that you brought up, right? Do presidential elections affect the markets? The answer is no, right? Not really.
No, I don't think so.
And I think the beauty of our country is that other stat you gave before, which is numbers I don't understand, right? The GDP, what were those numbers? You remember them?
Close to like 30 trillion, and the U.S. market cap just in the market is close to 50 trillion.
Right. And that's a testament to all of us, right? It's a testament to us going to work every day and making your hard-earned money. It's a testament to our business owners out there who are growing businesses. It's a testament to us continuing to do our thing, because that's what's going to happen, right? What happens Wednesday morning after the election?
Nothing.
Continue on, right? Right. From our own perspective, yeah, the world might shift, policy might shift, take some time, doesn't happen overnight, right? We spoke to somebody a couple of weeks ago. Joe, do you remember that conversation?
Yeah, he kept saying, we got to see on November 6th. I said, what happens November 6th? He goes, well, no, who's in the White House? So what's November 6th? I can make decisions. Decisions based on what? I don't know.
In a 30-minute call, we heard November 6th like 15 times, right? November 6th to November 7th, like at the end of the day, that's what we have to remind ourselves of. Not that much changes overnight. We are the ones who have to focus on ourselves, right? You focus on yourself, you focus on how different policies affect yourself and what your plan is, what you want for your family, what your money story is, where you want to grow. That's what we want to help our clients with the most. So 2 big takeaways from a financial planning perspective are:
make sure to plan based off of policies, but don't invest because of policies or markets.
Right. And
yeah, I think just to Joe's point, right? Don't mix politics and your investments, and try to remove all of the heightened emotions that the election cycle typically brings out of your portfolio.
Yeah, and for me, on a technical side of your own individual financial plan, is dollar cost average, right? Keep flowing money to the market every month. Pick a dollar amount that fits within your budget. We'll help you set it. Make sure that's flowing in the market, irrespective of what's going on. Shut out all the noise. And make sure the way you invest when you're taking that dollar cost average is diversified, right? Because different aspects of the economy will be affected by different things. That's just the nature of the beast. Most of those things that we didn't expect to happen, but happen. So the more diversified your portfolio is, it's your cheapest form of risk management, baby. So manage those risks at Thanksgiving. And for me, that's controlling how much turkey you eat. For Joe, it's brisket. For Bobby, what's the takeaway food?
Takeaway food? Ooh, I think mashed potatoes and gravy.
Amazing. So can't wait. Mashed potatoes and gravy. Great gravy, and great to have everybody here today. Looking forward.
All right. See you guys.